Welcome to The Explainer. Today, we're going to decode what I like to call the secret languages of accounting. These are some seriously powerful tools that go way beyond the standard rules to tell you what's really going on inside a business. When most people hear the word accounting, their mind immediately jumps to GAAP, right? The big, complex rulebook for public companies. But here's the thing. For a ton of businesses, especially the ones that are just starting to grow, that's not the only way to do it. Not even close. Today, we're diving into some really powerful alternatives.
So here's how we're going to tackle this. We're going to follow the story of a business, watching it grow right from the very beginning. We'll see it start with the simplest kind of bookkeeping, then level up its game, face one of those make or break financial hurdles, and ultimately, learn to speak a whole new language of finance. It's going to be quite a journey.
All right, let's get right into it. The very first thing you need to get your head around is this. Not every single business out there needs to get bogged down in the massive complexity of GAAP. I mean, for a lot of them, there's a much more practical way to go. And that practical way is something called a Special Purpose Framework, or SPF for short. Now, you might also hear an older name for this, OCBOA. It stands for Other Comprehensive Basis of Accounting. But honestly, just think of them as specialized accounting toolkits. They're designed to be way simpler and much more relevant for companies that aren't public and don't have all those reporting requirements. So there are actually a few different types of these SPFs, and each one has its own specific job. But for our story today, we're going to zero in on the big three, the ones you're most likely to actually run into out in the wild. We're talking about the cash basis, the modified cash basis, and the tax basis. Okay, so let's picture this. A brand new business is just getting off the ground. It's small, its day-to-day transactions are super simple. Really, all they care about is how much cash do we have in the bank? So naturally, they start with the most straightforward, no-frills accounting method you can find. And that method is the cash basis. It is as simple as it sounds. It's a pure what you see is what you get kind of deal. Did cash come in the door? Great, that's revenue. Did cash go out? Okay, that's an expense. That's it. It's absolutely perfect for organizations with really simple operations. Think small trusts or even political campaigns, all because of its beautiful simplicity. But you know how it goes. The business starts to do well, it starts to grow, and with growth comes complexity, right? All of a sudden, it's buying equipment, it's taking out a small loan, it's even starting to hold inventory. And a pure cash system, it just isn't cutting it anymore. It doesn't tell the whole story. So, what does it do? It levels up. It moves to what's called a modified cash basis. Think of this as a hybrid. It takes the simplicity of the cash basis as its foundation, but then it starts pulling in a few key ideas from the more complex accrual world. Things like, say, depreciating assets over time or properly recording debt. And the whole point is to create a much more realistic financial picture. This chart here really lays out that progression perfectly. It's like a roadmap for your accounting. You start with the cash basis when all you need is simplicity. As you grow, you move to the modified cash basis to get a more realistic view. And then, for even more complex situations, you might use the tax basis, which basically aligns your books with your tax return. It's like a ladder of complexity, and you just climb to the rung that fits where your company is on its journey. All right, so our little business is not so little anymore. It's absolutely thriving. And now it's ready for the big leagues. We're talking new locations, more staff, the whole shebang. But to do that, it needs a serious injection of capital. And that leads them to a very, very critical meeting. And this right here, this is that classic make or break moment. So many entrepreneurs and business owners get to this exact point. They've proven their concept works, they know they have something special, but now they just need that fuel to pour on the fire. And then the bank drops the bomb. Your books are great, but for a loan this size, we need to see your financials on an accrual basis. And boom, there it is, the big demand. Their modified cash basis books, which have worked so well up to now, just aren't going to cut it. The bank needs to see the full economic picture, not just a simple cash in, cash out report. This moment right here, this is what sets up our central challenge, the need to transform. So this really gets to the heart of the matter, the fundamental difference between these two worlds. On the one hand, you have cash accounting. It's simple, right? It's all about when the money physically changes hands. But accrual accounting, that tells a much deeper, more accurate story. It's about when the economic activity actually happens. You book revenue when you earn it, and you book expenses when you incur them, whether or not any cash has moved yet. It's a huge shift in perspective. So, our business owner now has a mission, a very clear one. They have to translate their financials. They need to go from speaking the language of cash to speaking the language of accrual. Now, I know that sounds super intimidating, but there's actually a really elegant, almost beautiful logic to how it's done. And here's the secret. This is a little passkey from our source material, and honestly, it's a brilliant insight. Think about it. If you already know how to prepare a statement of cash flows, where you start with accrual net income and work backwards to find the cash, then this conversion is just the opposite of that process. You're just reversing the logic. They are literally two sides of the exact same coin. Okay, let's make this real. We're going to walk through a concrete example and see exactly how a company, we'll call them ABC Company, pulls off this translation. So here's where we start. If you just look at their checkbook, ABC Company brought in $50,000 in cash and paid out $20,000. Simple math, right? That gives them a cash basis net income of $30,000. But is that the real story? Does that truly reflect how well they performed? First up, let's tackle revenue. We start with that 50 grand in cash they collected. But to get the true picture, we've got to adjust for timing. For instance, we need to add that $15,000 for sales they made but haven't collected the cash for yet. Why? Because they earned it this year. Then we make a few other adjustments for things like unearned revenue, and you see the real accrual-based revenue is actually $70,000. Big difference. Okay, now let's do the same thing for expenses. The company paid out $20,000 in cash, but hold on a second. 5 grand of that was for a new machine. That's not really an expense for this year, right? It's a long-term asset, so we have to adjust for that. Then we factor in other non-cash stuff like depreciation and, what do you know? The true accrual expenses are only $18,000. And so, what's the final result? After we do all that translating, ABC's true net income for the year is $52,000, not $30,000. That is a huge difference. And this is the much more accurate picture of profitability that the bank was looking for. It just tells a way stronger story about the health of the business. Okay, so you might be thinking, wow, that's a lot of work. So why bother? Why does mastering this translation skill matter so much for a business? Well, here's why it's so important. Being able to understand and speak both of these languages, both cash and accrual, is basically an entrepreneur's superpower. It really is. It means you can use a nice, simple system for your day-to-day operations, but then, when it's time to grow, you can fluently speak the more sophisticated language that lenders and investors require. It gives you the best of both worlds. And that right there is the key takeaway from all of this. The language your financials are speaking today is literally going to determine the kinds of opportunities you can even go after tomorrow. So the question you have to ask yourself is, what language are your financials speaking? And is it the one your future depends on?